Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Thursday. We are looking at, look, I mean, let's state the blatantly obvious, right? These are wild times in terms of price action, but let's keep in mind a couple things. Let's keep in mind, number one, the trend that we're in, all right? Let's keep in mind that we are still overall, it's a fairly fresh downtrend that we have. We pull back this low on the 7th that just exceeded a 20% pullback on the ES futures. By the way, that's when we have a setup in the Sector Secrets Mastery where we buy SPY. So that is a long position in our account, but it's a longer term. I say our account. That's something that I do. I share how to do that with the members. Now that's a longer term position. That's not about yesterday. That's not about even next month or even next quarter. It's about a longer term time horizon of minimum 6 months to hopefully multiple years to come. And that's really been my overall messaging for what's happening right now. Can we find opportunities where if we're not thinking about the next hour or the next day or the next week, even the next month or quarter, can we imagine ourselves sitting here April 10, 2026, October 10, 2026, 12 to 18 months from now and say, hey, do you remember when, so when '08 was happening, I tried to keep that in mind. I struggled with it. That was probably the biggest type of melee at that point in my career I'd gone through. Now, granted, I'd traded through Gulf 1 and Gulf 2, the tech bubble bursting, long-term capital management. You might remember that LTCM imploding, the ruble crisis, all these things, the Asian contagion. I'd seen things, but nothing on the scale of '08. For a lot of traders, this is sort of their version of an '08. And in many ways, it's not all that from a price perspective, different from what we saw in 2022. So remember, if you've been trading for a handful of years, you've seen volatility, you've seen weakness, maybe not at this breakneck speed. So when you talk to traders who've been doing this a little while, they're not going to comment necessarily on the speed of the thing. They'll talk about the scope of the thing, whether that took, in the case of 2022, what did that take? 6 or 8 months? This did not even take 6 or 8 sessions, but it's the scope of the thing that we're measuring. I really don't care if 20% pullbacks come in a week or if they come in a year. It's still a level, it's still a measuring stick that I'm looking at. Ultimately, when I look at what's going on Twitter, when I read comments, look, everyone's going to have their own emotional journey through this. But at the end of the day, it is not our job to comment on whether or not you or I think what's happening is right or wrong. We are not paid to be commenters, analysts. My job is not to, what's that holiday, Holiday Express? Are you a doctor? No, but I stayed at a Holiday Inn. Yeah. Are you a economist? Are you a stock analyst? No, I'm a trader, right? And so I think that the more that we can stay away from the emotional side of things, which, by the way, emotions don't keep the lights on, right? That's not how we pay. That's not how we pay the bills. So I put all of that aside. I just look at price, volume, volatility, and time, and I just get to work. And sometimes getting to work, right? Sometimes getting to work is simply doing nothing. Sometimes getting to work is saying that the metrics by which I know I have a high probability setup means that I have at least a 68% probability of normal volatility. We haven't seen that in days. And outside of that, outside of those ranges, I know risk management is going to be difficult. So remember, it's not necessarily at this moment about stock selection. It's not about predicting, today whether we're going to sell off or tomorrow. Who knew this was going to happen? I'm going to say the same thing I've said for a long time. Crashes never happen when people are talking about crashes. Just like yesterday's rally, remember the date, on Monday, Tuesday, all anyone could talk about is the bond yield curve inversion. And all anyone was talking about was lower lows. And here comes what they call, it's such a silly name, but it is what they call it. That's a face ripper rally. The thing that we're expecting never happens. The thing that we're all talking about is not when it happens, right? So keep that in mind. It's a little counterintuitive, but it makes sense when you think about what we think has been discounted or priced in and what we don't know hasn't been, right? So this is the way I look at this. And, ultimately, when we look at the overall moves right now, one of the things I mentioned yesterday on this inane discussion about, look, gang, the discussion about yield curve inversions is one that could have been had on and off for 2 or 3 years. It's absolutely inane. It did not predict this because it was wrong for the better part of the entirety of 2024. Right. So please don't get caught up in these. I know they sound very sophisticated. You know how you're going to know if I'm bullish or bearish? I'm going to be talking about puts or calls. I'm going to be long or short. The position itself speaks volumes about what I'm doing. So when I tell you I bought SPY, you think, okay, Raghee bought the SPY and she explained her time horizon is very long, 6 months minimum, years, hopefully. That's what I'm doing right now. What else do we buy in Q1? Coke, Walmart, XLC, and Altria. Right? I've got these longer term long positions and I'd like to find a whole lot more of them. Right. And again, it's not my job to in any way say I know what's coming next, but I can tell you this after 35 years, it's never different. It's really interesting. I've never seen so much chatter out there about this time is different. Right. And you know what? We can all talk about it a year from now. Pretty sure what it's going to look like, but that's okay. Everyone's got to put their positions on in a way that suits them. All I'm saying is don't rely on emotion, political or otherwise. That's just amateur. It's not going to pay you, right? And again, I think ultimately our job as traders is to manage risk. And if this environment is one where you say, Rob, manage risk, stay on the sidelines, right? There's nothing wrong with sitting on the sidelines right now. Or I think the two best ways, aside from sitting on the sidelines, is either shorten the time frame. We had a day trade in the QQQ to the long side yesterday, or go out to the weekly time frame. So right now, those extremes, very, very short or very, very long, are proving to be places where I can manage risk. That's really it. The other thing to keep in mind right now is that the cause for the volatility is on a monetary policy thing. It's not about the Federal Reserve miscommunicating monetary policy. This is not high concentration weighted stocks, missing earnings. These are not internal market reasons. They're all external. These are all exogenous reasons. And whether that's the pandemic, exogenous, whether that's right now geopolitics is always exogenous. Remember when the Ukraine war was supposed to wreck the markets and the Federal Reserve was going to act because of that? It was as inane then to think that was an internal market issue. It was an external one. This is an external one as well. And those are far more difficult to trade because rather than it being market data that sends things higher or lower, it's headlines. It was a post yesterday, right? If you think about Monday, there was that rumor that was floated around, right? It ended up not being true, but it sent the market up regardless. So these are difficult times, gang. Another thing I want to mention about the bond yields is the bonds. This is a look at the 30-year bond. It's going absolutely nowhere new, right? We were lower than this, meaning a higher yield back in the middle of January. If you take a look at the notes, same thing. It's not going anywhere new, right? If anything, we're just coming off some serious highs, and that would have been discussions that were had before, right? Let's just call it what it was, the Rose Garden announcement. This was before or with the Rose Garden announcement. We're right back into normal ranges again. So let's keep this in mind. Look at the chart. don't read the analysis of, right? Go a little upstream and say, okay, if the analysis is, for example, yield curve inversions, how long has this been happening? I'll tell you right now, gang, years. Is the bond market somewhere new where this calculation is something that we have to discount? Not really. So that's where I'll go back to the chart, trade what I see, not what I think. That's how you get through this stuff. All right. Let's go ahead and see what we've got as far as questions. And good morning to Simpler Essential. Good to see you all. Good morning to the YouTubes out there. All right. Any questions? Let's see what else we have. Bond yields are increasing. Yeah, but the 10-year yield on the 4th, right? You can see here on the 4th and the 7th, those were new highs. I mean, you could even say the yield on the 3rd was the new high. But remember that the way in which bonds move, and by the way, if bond yields increasing, on the 3rd, so let's go back to say the S&P on April 3. Or bond yields dropping, whatever direction you're concerned about. Let's talk about both the directions. First of all, when you look at notes or bonds, ZN is notes, ZB is bonds. When you look at notes and bonds, when the actual futures contract is moving higher, right, that's rates moving lower. And when the contract is moving lower, that's rates moving higher. So it's not directionally, it's directionally inverse. So on April 3, this is April 3 right here, April 2, April 3, as that was making a higher high, yeah, you can see here the S&P did break some support. So we actually had resistance on the notes and we had some support on the S&P. That's going to be helpful, right? That's going to be helpful. Certain thresholds were broken. That's what trading is. At the end of the day, everything we do in trading boils down to support and resistance. If any analysis I'm talking about can't just be reduced to support, what is support? Support is buying. Support is a floor. Support is demand. Use whatever lingo you want. That's what support is. And resistance is what? Resistance is a ceiling. Resistance is sellers. Resistance is supply, right? Whatever word you want to use, everything should just boil down to is this support or resistance. So I agree. On the 3rd, you can see here we broke support on the S&P. We broke resistance in the 10-year. Those are things to keep an eye on. Absolutely. But that's charting, right? That's trading 101. What I'm talking about is kind of succumbing to this conversation around whether or not the policies are going to do whatever they're going to do fast forward. That's never been the job, gang. And I know it's an emotional time for a lot of people, but great traders know how to shelf that. The market doesn't care what I think. And I hate to say it, doesn't care what any one of us think. It really doesn't. Either people want to buy or people want to sell. And our job is to find support and our job is to find resistance. That leads me to things like yesterday. Yesterday was a great big up day. And does that mean it's going to continue? I'm surprised it didn't continue a little bit. A lot of times your average retail trader will go home and see that level of rally and they'll want to engage at thinking the bottom is in and they missed out the move. That's actually not happening, which is really, really good. I'm pleasantly surprised that retail traders are not blindly, zombie-like wandering in long. Now is not the time. As long as the lows are holding in the S&P, I'm going to look at this as a bottoming process. Calling a bottom is fortune telling. None of us can do that. It's crystal ball. But bottoming processes is a setup, right? And for now, based on what I see, I'll look for a bottoming process. Doesn't mean that it's in. If the setup evolves, then great. Then I know I have potentially a trade. There are a lot of really good corrections happening on the weekly time frames. And a lot of those are showing very positive signs, but that's again for traders who have a far longer time horizon. Okay. And so we're just dealing with a lot of volatility, gang. We're dealing with news and people are acting in a rather emotional and arguably irrational way. Yesterday was complete irrationality. Frankly, the move lower was complete irrationality. But look, the markets can remain, there's an old saying, the markets can remain irrational longer than I can stay solvent. Again, it's just a matter of volatility. And until it normalizes, which it's not, it's going to make a lot of sense to sit on the sidelines, right? So again, This more so now than ever, we stick with our process. More so now than ever, we want to define what the markets are doing just simply with, is it at support? Is it at resistance? Is it in a downtrend? Is it in an uptrend? Or is it in chop? It's the same thing we would have done 6 weeks ago, right? Okay, so let's see. TD asks, do I think Tesla is likely, all right, let's go take a peek here. Bear with me. Do I think Tesla is likely to come back down or continue off yesterday's pump? Well, again, I'm going to go back to exactly what I said, TD. TD, nobody in their right mind can answer that question for you. Nobody. Because what that means is I know what's going to happen tomorrow or the day after. Newsflash, nobody does, right? So what we're going to do is go back to, did yesterday's rally carry it to resistance? Did it carry it through resistance? Did it carry it down to support? Did it carry it down through support? How much volume was associated with that move? Is it at key volume levels? Is the volatility all the things that we would talk about before we still apply today. Tesla has rallied to the point of control. That's a decision level. So that's the point of control basically for this year. The point of control is the most number of shares that's been traded in Tesla. And in this case, since I've anchored it to the beginning of the year, it's anchored to the beginning of the year. So what I want to remember then is this, as long as it's overhead, is a ceiling, right? It's resistance. So if I were to look at this and then look at the trend that preceded it, I would look at Tesla as still being a weak stock in terms of the daily time frame. It's still below these white dots, which is basically a moving average crossing tool, a short EMA versus long. In essence, it's got a few other bells and whistles in the coding, but it's basically an 8 EMA and a 200 EMA. And when they've crossed, the dots light up, and when they're uncrossed. So think about classic moving average crosses. We've basically automated the visual of it. Being below that is bearish. Being below the point of control is bearish. So it rallied right up into not a price resistance level necessarily, but a volume resistance level. Again, there's only 4 factors in the market. It's on emotion or politics or opinion, right? It's price, it's time or date. It's volume, it's volatility. Those are the 4 things. Those are the 4 as objective things as we can find. Everything else, right, can boil into analysis, opinion, subjectivity, right? The biggest thing that any of us who are trading can do is know what time frame we can manage risk on and what symbols have the highest probability for follow through. For me, it's one extra step. Make sure I'm being transparent about direction, time frame, time horizon, right? And risk. And right now, obviously, and no one needs me to tell them, this is high volatility. High volatility is just another way of saying higher risk. The premiums are inflated right now. The price movement ranges are far less predictable because we're in that rare air. We're outside the 68% norm. And again, if you ever see that, coupled with the high VIX and all those things, we're in different times. Now, I mentioned high VIX, and that's going to it's usually a lagging look compared to the daily price movement ranges. But again, with that longer time horizon, take a look at what peaky high VIXs have meant, again, with that longer time horizon. They're bullish, gang. They're inflection points usually. And if you look at back to 08, I know every time, this time is different, except for all those other times, everyone can do whatever it is they want. My job is to, frankly, talk my book, talk my analysis, share with you what I'm looking at. And I try to back it up with data. And so the peak VIX readings tend to be, again, not a week from now or a month or a quarter from now, years from now, they tend to be amazing buying opportunities. All right. So that's what we're looking at right now. Okay, so that's really it, gang. That's really it. That's what I'm looking at. This is just, this is where I say use what's helpful. Just consider it another point of view. My job is not to be right. My job is not to call market bottoms. My job is not to predict what's going to happen. Our job is, the market is the pitcher. We are the batter. And either it's a pitch that we want to swing at or it's not. And there's no harm in not swinging at anything. So I know a lot of folks looked at yesterday. Gang, make sure we know the difference between luck, right? Being long yesterday was luck. And I'm all for luck. I'd rather be lucky than good. But I do know after 30 years, it's good. It's having all the different principles of being a process-driven, patient trader. That's a career, right? Hey, I'll take luck any day. I get that from time to time too. But there's a lot of traders, throwing confetti into the air because we had a ridiculous rally. I'll take luck. But remember, we're going right back to trading today. Okay, gang, be good to each other. I'll talk with you soon.